Good day, everyone. This is Nick Cacco from BMA, welcoming you to our February webinar, Why Standard Costing Leads to Poor Financial Decisions. So, of course, the first thing we need to do is the technical check to make sure that you can hear me, you can see me, and you can see my screen. So if any of you can sort of type in the question pane that you can hear me, see me, and see the screen, let me know, please. All righty. Thank you very much. And on the more on the technical side, if you want a copy of the presentation, it's in your control panel and in handouts or handouts. You can download it. If you forget to do that, that's fine. Or if you're watching the recording of the webinar, just send me an email and I'll be glad to send one out to you. And then if you are a certified public accountant in the United States and would like to get a continuing education certificate, I can send you one. The 3 requirements on your end is to answer 3 of the polling questions, be logged into the live event for at least 50 minutes, and then you can get your certificate. And of course, even if you're not a certified public accountant and you'd like a certificate, I'll be glad to send you one. All right. So let's do the practice in the polling questions. And let's start with one right now. It's very simple and just a basic attendance check. Oh, I got to launch it. Sorry about that. Oh, and by the way, while you're doing the poll, if you have any questions, type them in the question panel. I'll try to get to them either during the presentation when we're looking at doing the polling questions or at the end. All right, so let me close this poll and let's get back to things. All right, so what are the learning objectives today? Pretty simple and basic. One is to study standard costing for a few minutes and understand how it makes fixed costs appear to be variable. And that's one of the sort of the drawbacks of standard costing, especially when it comes to making financial decisions. You should be able to explain how box scores integrate the economics of lean into the decision-making process. I'm going to show you some examples. We're going to compare and contrast, looking at a particular analysis using standard costing and then using lean accounting, and you'll see the differences there. And then we'll do some wrap up and some questions. All right, let's get started. All right, so what is the current state of standard costing as it relates to financial analysis? So over the years, this is what I've sort of uncovered in working with companies, is that many companies use a standard cost to calculate a price. That's known as cost plus pricing. Okay. And I understand, actually I was working at a company this week that they do this. And, I understand that in terms of like quoting a price, There has to be a methodology to come up with a price that you feel will cover the costs and use and create a profit. But that's not always the price that the customer's willing to pay. And the other thing is that whatever kind of like standard margin you calculate, if you're quoting a price to a customer, that's not necessarily how much profit you will make when, for example, if the customer accepts the order and orders the product or delivers the service. And I'm going to show you that in an example. Understanding profitability and cost, obviously the cost of an order, the cost of a product, the profitability. You can take this as far as product families and customers. This idea that you have sales less a standard cost and you get to a standard margin, it's, because all the numbers are in the system, it's not too hard to extract and say, what's the profitability of this customer, for example. And then in financial reporting, the standard costing system is used to value inventory, value cost of goods sold. So on your external financial statements that you distribute to executives and shareholders and other stakeholders, the numbers on there. So, this idea of sort of just, get rid of standard costing. It's a sort of a complex problem that it requires you to take standard costing and think of it in different aspects and break the big problem into smaller problems and solve the smaller problems one at a time. So for example, last month we looked at the operating practice piece. Today we're going to look at the financial practice. I say, so here's the problem. Okay, the basic problem with standard costing. Standard costing is a cost allocation methodology. And the methods to assign costs to products or even to create, for example, the labor and the overhead rates, they are subjective and they are arbitrary. Okay, a decision has to be made. For example, if you're calculating an overhead rate, what overhead dollars are we going to include? And what's interesting is, between company A and company B and company C, there's different ways that they all do it. It's not the same. Then you think about like an overhead rate and the denominator. Okay, so, that the denominator is labor, typically standard labor dollars. And so how do you get the labor dollars? It is a labor rate, which may not be that difficult to calculate if you know the salaries and wages of the people that work in a work center. Then you get into the hours. So, the denominator, how many hours do we expect? It usually comes down to this, how many standard hours do we expect to produce? So, you can look at what did we do over the last 3 or 4 years and just, come up with a number. But, what's interesting about calculating the denominator, what are the hours we're going to use to calculate the rates? What actually happens in terms of the standard hours that are actually produced is all dependent on the product mix. So again, there's the human element of making some of these decisions. So therefore, this means that a standard cost is not accurate. It is an estimate, okay? And in the fourth part of this slide, it is also not how actual costs behave. And what I mean by that is pretty much labor and overhead. They do not vary with each unit sold. So, if you have a standard cost, you have material, direct labor, and overhead. And, let's say the direct labor is, $30 per unit for a certain $30 for a certain product. And so the thinking is, if I sell one unit, it costs $30 in labor. If I sell 100 units, it's going to cost, $3,000 in labor. But that is not how the labor costs work, nor the overhead costs. So let me explain this a little bit. But first, I'm sorry, we have to think of, and here's the thing. The way that standard costing works, example like the direct labor, it drives certain thinking habits. What do I mean? I mean, okay, we see a direct labor dollar, so we think direct labor varies by every unit sold, okay? And that then drives behavior. So for example, in companies that are like fully committed to standard costing, there comes where they're like, oh, we got to take labor out of the product, because what happens if you take the labor out? Okay, you spend less time, less time on producing, then it's like, oh, this product is less expensive now. Okay, and then that drives the decisions, and the decisions drive the numbers. And so, standard costing is deeply embedded. If you have a standard costing system, likelihood is that it's deeply embedded in the decision making and the way people think about how costs behave. And you can look at two similar products, and just because they have a different amount of labor time, their cost is going to look different. But in reality, if these products are similar, the costs, that's not how the costs behave. Okay, so when you're thinking about the financial decisions in your company and how standard costing works, it's not just the numbers, it's the way people think about it. And if standard costing has been around, the thinking habits are deeply embedded in the people that work in the company that use the information. So how do we get around this? Well, the first thing to do is to really have a very good, what I would say, lean accounting definition of costs. Okay. So variable costs. Okay, what do? They vary directly with short-term volume changes. The best way to think of it is, if we sell one more, we incur the cost. The cost changes. Okay, or if we sell fewer, the costs go down. That's a variable cost. So it's sort of a direct relationship. Now, fixed costs, they do not vary with short-term volume changes. Okay, fixed costs change, but they typically change by management decisions. Okay, and lean thinking, more costs in an organization are fixed than variable. Okay, now it's funny, I was working at a company this Monday and Tuesday, and they're a good lean company. They've been actually, committed to lean accounting for over 10 years. And so we did a little bit of refresher training for the new employees that are in the company. And, so we had lots of discussion about variable and fixed costs. Okay. And it's a mind shift. And that's what it is. And that's why it's very good, especially if you're in accounting in your company, is to make sure people are thinking the same way about costs. Okay. So here are some examples of thinking. So variable costs in standard costing, it's the material, it's the labor, it's the overhead. But in lean accounting, it's just the material. Okay, this is a very big shift in fixed and variable, and it has a significant impact on analysis and decision making. In standard cost thinking, all the fixed costs are like indirect, or overhead costs, and indirect costs, not direct. And lean accounting, the labor and the overhead costs are considered fixed. In fact, in lean accounting, we try to avoid using the word overhead, and we talk about actual costs. Okay, and this is one of the biggest changes in thinking, and to get people to understand that labor doesn't change. Your full-time employees, that's a fixed cost. What do I mean by that? You will pay them. They come into work every day and you pay them. You pay them if they're producing a product, or, for example, doing 5S activities. Okay, you're still paying them. And that's a fixed cost. Okay, you don't, just because maybe people don't have as much work to do today because there's no orders, it's not like you sort of send them home and don't pay them. Okay. And when it comes to cost allocations, the standard cost in the standard costing world, it's about, we need to allocate as much overhead as possible into the overhead rate so that, we're covering our costs when we price. But in lean accounting, we're more focused on what are the actual direct costs of the value stream, for example. What are the shared costs? And if we want to assign shared costs, how do we do it in a simple, easy way? All right, so let's open up polling question number 2. I'm going to launch the poll. While I'm launching the poll, I'm going to look at questions. Okay, and one person asked me, what is a box score? That is exactly what we're going to be talking about after the polling questions are finished. All right, I'll give you about 5 or 10 more seconds. Excuse me. All right, I'm going to close the poll. I'm not going to share the results, and we will move on with our presentation. All right, so, what is a box score? And we're going to explain it, and I'm going to show you how it's used to replace standard costing in making financial decisions. So before we actually get into the details of the box score, what's important to understand is what I like to call the economics of lean. How does lean work financially? Okay, there's lots of knowledge out there about the operational benefits of lean. There's a lot of financial benefits of lean too, but you have to think a little bit differently. So, a foundation of lean thinking is continuous improvement, and the primary result or the primary benefit of most continuous improvement activities is to create capacity. Or another way to say this is create more time. And just think about this, okay? You know, especially if you've been involved in continuous improvement, you know, if you are doing an improvement event and you reduce or eliminate a wasteful activity, which typically means, you know, the employees don't have to perform that activity anymore. The employees now have more time. That's one of the reasons why lean is often called a time-based strategy. It's about understanding how much time are we spending on our customers or serving our customers, how much time are we spending on all these other activities. So the economics of lean basically means, you know, understand the capacity that is being created. And then what are you doing with it? So you can take that capacity and serve customers better, deliver value better. For example, you know, you reduce your lead times, you improve your on-time delivery, you improve your quality. All of that is valued by your customers, and that can drive revenue growth, sales growth. Okay, serve customers better, and if you're serving them better than the competitors, you're probably going to get more sales. So there's a revenue impact there. Likewise, you can use that capacity to achieve cost reduction over time. All right, now the idea here, and I'll give you a simple example, is that, you know, if you do some improvement activities and free up employees' time, that might allow you to not hire more employees in the future, because you've basically you've created the capacity through continuous improvement, as opposed to buying the capacity and hiring people. That will lower your labor cost as a percentage of sales over time. And so this is why it's important to incorporate box scores into the financial analysis and decision making, because it really drives the financial success that companies can enjoy with a lean strategy. So we're looking at cause and effect, okay? You know, you know, the effect, you want to improve financial performance. What's going to drive it? What's the cause? Improved operating performance and or improved capacity usage. So it doesn't work the other way around, okay, which is the traditional sort of top-down financial management, where, you know, leaders of the company or the, you know, financial leaders say, you know, you need to reduce your costs by 5% next quarter. And you get into the line managers, all the managers, you know, in the departments and functions in your company, and okay, I have to cut 5% of my costs out very fast. That's not easy to do, okay? And maybe it might sort of work, and, you know, it could work in a very negative way, meaning, oh, well, if I have to cut my cost 5%, then, you know, this purchase I was expecting to make, I just won't make it this month, and I'll make it, you know, I won't make it this month. I'll just save it and buy it later when, you know, and so I achieve this cost reduction. But in my head, I know that I'm going to buy it a few months down the road when we stop talking about lowering our costs. So that's not good behavior, okay? What you want is you sort of want operational people to be focused on continuously improving their processes, driving out waste, spending more time serving customers. That will yield improved financial performance in a more natural way. So the box score is the three-dimensional view of value stream performance measurements. So how well is the value stream performing? Is it improving productivity, improving on-time delivery? If in manufacturing, you're flowing the materials faster and your inventory days are improving. Quality, is quality improving? How about the average product cost? Okay, is that going down over time? So these are the lean operational performance measures that that measure what's going on. They reveal problems, and then they show the result of improvements. The value stream income statement is the actual revenue or sales for the value stream and the actual costs. And what's important to understand here, in lean accounting, we look at value streams as profit centers. They have revenue because for example, you fill an order and you ship it, so you get revenue from that. And we look at the actual costs associated with that value stream. And the third piece is capacity. Productive time. How much time are we spending serving our customers and delivering value? How much time are we spending on all of the non-productive activities? How much time is being created due to continuous improvement? So with the box score, you can now visually see how these relationships work between improving operating performance, improving capacity usage, and as a result, improving financial performance. So I mentioned earlier about numbers drive thinking and how standard costs drive a certain type of thinking. The box score will break those standard cost thinking habits. That's what's important to understand. That's why it's important to create a box score and then begin using it in the analysis and decision making. So, this is I'm going to show you 6 sort of ways that lean thinking can drive financial performance, and they are all incorporated naturally in the box score. Excuse me. So lean thinking can increase sales without increasing your fixed costs. If you have available capacity and you have the opportunity to sell more of your products or services, you're going to get the sales. The only other costs that change are the variable costs. The fixed costs stay the same. So, sales less variable cost, that's contribution margin. So the contribution margin of this new business is really the profit you're going to make. We talked about reducing fixed costs as a percentage of sales over time. Through continuous improvement and the economics of lean, for example, your labor cost as a percentage of sales will go down over time because of lean practices. There's also opportunities maybe to reduce your variable costs and improve your contribution margin. For example, in manufacturing, you buy less inventory, You're scrapping less material, and all that reduces the amount of inventory that you're buying, and it improves the contribution margin. Increasing capacity without increasing costs. This is the economics of lean in action. Think of it in terms of continuous improvement. All those improvement activities are eliminating portions of wasteful activities. And it creates a lot of capacity. It also creates a lot of flexibility in terms of, moving people around, giving them different assignments, combining operations and things like that. Improving performance and increasing capacity. Single piece flow, creating flow, reducing your lead times, improving your delivery. It takes out a lot of waste, and it improves performance and it increases capacity. And finally, improving cash flow. The best example of that is in manufacturing with inventory. If your days of inventory improve, you will have more cash. Okay, because inventory in financial accounting, inventory is an asset, because that's what the rules say you have to do. But in reality, inventory is products you've purchased or made that are sitting there. Okay, it consumed cost, and that cost is sitting as an asset. But in reality, it's also cash sitting there, because once you sell that finished goods inventory, eventually the customer pays you. So the idea behind the box score is that it drives thinking habits around these 6 possibilities, when you're doing a financial analysis. Now, it doesn't mean all 6 will occur because of just using the box score, but it drives people to think. I'm going to go back a slide just to put the box score up. So if you think about this, you have a current state box score, and what you're trying to do is create a future state box score. So you have the box score being a tool, you sort of have to look at every line item in the box score and say, okay, here's the current state number. If we make this decision, what does the future state number look like? Is there a change or not? So it naturally drives this type of thinking. And what you get out of it is a more accurate financial analysis in terms of what will happen in a business decision. All right, so let us take a short break and do polling question number 3. While you're doing that, I'm going to look at the questions, see if we have any more. No, we don't. If you do have any questions, you can jot them into the question pane right now, and I could read them while you're doing the poll. Give me about 10 more seconds. All right, I'm going to close the poll. Not going to share the results, and we will move on. All right, so what have we done so far today? We've looked at standard costing and sort of how it takes fixed costs, primarily labor and overhead, makes them appear to be variable, and that's not exactly how the costs behave. And then we looked at the box score, which takes into account how operating performance and capacity usage impact costs and financial performance. So let me show you some examples, and these are actually real life examples that I worked on with companies over the years. The names have been changed. There's no names, but the names have been changed to protect the innocent. I'm not going to talk about exactly which companies we worked in. All right, so here's the first example. Your company requires a minimum 15% standard margin on products that are sold or priced. So a customer comes and wants to buy 3,000 units per month of the product Pro Valve 602. And the customer says, I want to pay $45 per unit. However, knowing the standard cost of the Pro Valve 602, it's pretty easy to understand what does the price need to be to get a 15% margin. Well, the price is $50. Okay. What else do we know? We know there is not enough capacity in the value stream to produce and ship 3,000 more units a month. So the question is, what course of action would you take? So what this company did is they first looked at, they were using standard costing. All right, so we have $45 per unit, 3,000 units a month. We know the material cost is $17.50. We know that the hourly labor rate is $30.32. And we know that it takes 750 seconds to make the product. The overhead rate, 293%. So, these numbers right here, they're all embedded in the standard costing system. So the material cost is $17.50. The labor cost is $632. The overhead cost is $18.51. You add those numbers up, you get $42.32. And when you subtract $42.32 from 45, you have a standard margin of $2.68, which is 6%. And what you would do is you would say, no, we're not, we can't sell you this product for $45. We need $50. Okay. So what this company did, and it was mainly the salesman who was he wanted this order. So he goes to purchasing and he says, hey, can you find a supplier who could basically make this product for us rather than we build it in-house? And the supplier does come back and says, oh yeah, I can find a supplier. They're going to charge $33 a unit. There's some like shipping and overhead costs of $2.48, but the landed price for us is $35.48. So again, using a per unit profitability calculation, salesman came up with, $9.53. That's a profit margin percentage of 21.17 or 21.17%. Yeah, I can take that order. Okay, and we'll just outsource it. But what happened is the lean people sort of said, no, let's take a step back. Okay, let's look at making this product in-house, but let's look at it through the lens of a value stream income statement and a box score. So here is how the value stream income statement was calculated. Okay, you have the current state that you see on the left. The middle column is what is the total incremental change if we accept this order and we don't have the capacity, which means we have to hire more people. And it was hiring more people and buying another machine in order to be able to produce this product. So you can see the incremental costs. You know, there's more material, 52,500. There's more labor, 9,476. There's more machine costs, 3,067. And then when you add the numbers up to get to the future state, you see that even with having to hire people, buy a machine, that the return on sales, 312,541, is better, is still greater than 15%. Okay, so would you accept this order and make it in-house? Yeah. Then when you line the options up in a box score, so here's the current state box score, okay? You know, if you outsource, and this is where you get the complete picture. Okay, we know that we're going to make more money outsourcing, okay? More sales, more contribution margin, the material cost goes up, all the other costs stay the same. So we make more money than looking at the current state. One of the problems is the performance measurements. You know, you can see on-time delivery goes down, average cost per unit goes up, quality goes down, and the days of inventory go up. Now, why did this happen? Well, the supplier was, you know, in a different country. And so it required, you know, buying large bulk purchases and having that sit in inventory. But when you look at the in-house, okay, you see more positive impact. Okay, the capacity is better distributed. We make more money making it in-house than we thought, because standard costing sort of doesn't tell you the truth. Performance is better, okay? So you can see the performance measures in green. Now the average cost per unit goes up a bit because what you're doing, you know, you're buying, you need 3,000 units a month, but you're you're hiring people, you're buying a machine, and they have a whole lot of capacity. So you bought more capacity than you needed, but it's still a good financial decision. Let's do one more example, right? And this is a truck maintenance company. So they have two value streams: routine maintenance services, major repairs. And a customer comes to them and they would like routine monthly maintenance on their fleet of 500 trucks. They will pay $38 per truck. So, you know, the routine maintenance, this is things like just do simple oil changes, look at the fluids and stuff like that. You're not doing any major repairs. So what this company knows is that in the routine maintenance services value stream, that the variable costs per truck are 17, and looking at it from a standard cost perspective, the labor and the overhead cost per truck is $10 per truck. So the first thing they do is calculate, you know, what's the standard margin. So the total cost per truck is 27, $17 in variable costs, $10 in labor and overhead. So the standard margin on this particular request for some, request for a quote, the standard margin is 29% per truck. The required margin under standard costing is 35%. So again, just looking at it from a standard costing perspective, you might say, no, we're not going to take this. We can't do the work for $38. We need a higher price to, make more money. So the question is, would you accept this order or not? Okay, there's not really a right or a wrong answer, but it's just that standard costing, we're not going to do it. All right, so I want to introduce this concept of the hurdle rate. The hurdle rate is the minimum contribution margin that needs to be achieved on any order to cover the variable costs, cover the fixed costs, and generate the operating profit you would like to have. So it's a pretty simple calculation, and this is sort of the plan for the maintenance value stream for an average month. So they know, or for a year. So, fixed costs of 616,000, that's 22% of the planned sales. They'd like to make an operating profit of 980,000, that's 35%. So you just add those two numbers together. So the hurdle rate is 57%. So here's how you can use the hurdle rate. You look at the variable cost per truck, $17. You divide, and you see it's, okay, so we're making 21% or 55%. We're not making 57%. All right, so, it's a little simpler than standard costing, but then it still sort of begs the question, how much money, or would we accept this order? So that's where you have to look at the box score, okay? So here we have a current state box score, and in column B is the opportunity, okay? That's the 500 trucks at $38 a truck. This is how much contribution margin will be made. The problem is the capacity, okay? Those 500 trucks will consume all of the available capacity. It'll run it a little bit less than zero, -1%. What that means is you either have to hire people or work some overtime. So just on the surface, it's not because the standard cost is too low, it's because we don't have the capacity. So then the question becomes, at this price of $38, what could we do to create the capacity to take this on? And you could hire people, okay? That's column C. And if you go down into the value stream cost, you can see that the labor cost and the overtime cost goes up. And in the net result is you're only making $500 more a month. The other opportunity is to do improvement, okay? Eliminate waste and create the capacity. And that's what column D shows, where there were improvements in quality, reduction in lead times, things like that. So in that case, you generate a great deal more profit. Okay, if you look down at the second to last line, value stream profit goes from 65,000 a month to a little over 80,000 a month because you've improved and created capacity. So again, standard costs don't tell the whole story. And it's really, really important to, sort of employ the economics of lean thinking by looking at it through a box score. Now, there's lots of other considerations. And so I forgot to tell you the end of the story. What this company decided to do is they accepted the $38. They were good at continuous improvement, so they knew that they had to sort of get these improvements in place rather rapidly to see the benefits of that. But another reason that they wanted this was, it's not just a box score reason, is that this customer was a customer that they really wanted to acquire in terms of doing the major repairs. So what they decided is, okay, let's accept their price on the routine maintenance, and let's do a really good job. And then we can talk to them about bringing the major repairs in, which had, a whole lot more, they're much more profitable than just the routine maintenance. So that's the two examples. Let's do the final polling question. I'll take a look at. All right, so there's some questions, and we'll have some time to get to them, because I just have like one or two quick wrap-up slides, and we have about 8.5 minutes left in the webinar. All right, I'm going to close the poll. I'm not sharing the results. All right, so to wrap things up, just remember, complete the survey that you get. If you want a continuing education certificate, write me and I'll send you one. Also, I don't know if it's on the survey or not, but if you have any suggestions about webinars to do in the future, please either put them in the survey if there's the ability to do that, or just send me an email, because I'm always sort of trying to listen to what the customers are saying. So the box score drives quality decision making, which is really the goal of lean management accounting. Box score information is relevant information to users. It's understandable and useful because it's based on the economics of lean. It's also very timely. You get updated box scores frequently. And it's reliable. It represents reality. You can verify all of the information in that box score, as opposed to standard costing, which focuses more on just creating these rates and allocations. And typically companies set standards once a year, so they're outdated very, very quickly. Box scores represent reality. So in terms of migrating from standard costing, there's 3 areas that standard costing is sort of deeply embedded in a company: measuring operating performance. And we talked about that in January, that you replace variances and absorption with box score performance measures. We talked about the profitability analysis today. Then there's the inventory valuation piece, which we're going to touch on in March. So again, this is a migrating process. It's a transformation process to move away from standard costing. It takes some time, can be done. It depends on the size and complexity of the company and how standard costs are used. All right, so I'm going to put this up while I start answering the questions. So this Friday is the official book launch of the Lean CFO second edition. There's the link to get to register to attend. All it is it's free to attend. You get the Zoom link when you go to Eventbrite and you buy a ticket. It'll be fun. It's going to be about an hour. We're going to have some panelists on who actually they work in companies. They're involved in lean accounting. I've been working with them. They all read the first edition of the Lean CFO. They've also read the second edition of the Lean CFO. So please join us. And even if you can't attend the live webinar, I'm sorry, the live book launch event, it'll be recorded. And as long as you register, you'll get a link to the recording. And then the March webinar is going to be on the 1st, where we're going to deal with inventory valuation and eliminating standard costing. So let me look at some questions here. All right. So hold on one second. Oh, so Megan asked, what time period do you normally use in a box score? It can be weekly or monthly. I mean, you like the performance measurements to be weekly. It's hard to do a value stream income statement weekly because, not all the expenses come in a nice routine manner. So value stream income statements may be monthly. Capacity, you update periodically after improvement events have been completed. So John asked me, what have been some of my suggestions for overcoming data issues? Well, you really think about it. You design, okay, and then you got to find where the data is, and that's sort of more of a getting just learning where the information is. And if you build box scores, for example, in spreadsheets, that's fine. And then from there, it's that's where the information and technology people sometimes come in handy, and you can access the data in different ways. I worked at one company, and the plant controller was really good with whatever their data reporting system is, where you can go in and you can just choose any information you want and build reports. And he actually ended up pretty much building a box score through that. So Megan asked another really good question. How does a box score take into consideration materials purchased in advance of the revenue earned and the matching principle? Good question. All right. So first thing to understand is that a value stream income statement is an analytical tool. Okay. And what should the material cost be on a value stream income statement? You really have two choices. It can be material purchased, or it can be material issued into the value stream during the period that you're reporting. Okay, we're not in the value stream income statement, we're not concerned with cost of goods sold. Okay, for those of you who are not familiar with that, that's a financial accounting term where you have to match the costs in any reporting period with the revenue recognized. And that's what standard costing does, by the way. If you sell this product, that standard cost goes from finished goods inventory to cost of goods sold, and it matches. But because the value stream income statement is an internal document, you really don't have to be concerned with that. You want to try to show what's the actual revenue. Oh, I'm sorry, somebody wrote they couldn't see the presentation. It'll be recorded, and you can watch it again. Sorry about that. Megan, you asked another good question. How do you measure capacity in the box score? That's a separate discussion. I can't do it in here in the last minute, but it's there's a webinar about measuring capacity. It's on our YouTube channel. You can get to there through our website, and learn, or contact me and we can talk about it. And then Jared asked, is this recording? Can we get a copy? You will be getting an email later this afternoon with a link to the recording. And then Jorge had a final question here. How do we reduce labor when sales increase and you have to hire more people? Well, that might be the case. Okay, but if you're hiring people what you're doing is you're buying capacity. And if demand is going up and you hire people and they are actually producing product, you'll make more money. I mean, that's what example one showed, where, ProValve 602, they had to hire people and buy a machine and they still made more money. Okay. So anyway, thanks for your questions. Thanks for attending. We're at the top of the hour. So I'm gonna wrap the webinar up. You have any questions about webinar, please contact me. Hopefully I'll see you at the book launch on Friday and see you at our next webinar in March. So all of you, please have a good day.